Well, it's 2:01, so I think we'll go ahead and get her started here. I'm Chip Holbecky. I head up the Raymond consulting team and get the chance to moderate a fair number of these things, helping to arm our associates and clients and other friends with all of the latest and greatest in what seems to be a increasingly fast-changing professional world. We started talking about a few of the changes that came out of the Consolidated Appropriations Act that were unexpected among the Raymond real estate team a few weeks ago. There was a couple that really were surprises, things that probably unexpectedly disadvantaged landlords a bit. A couple of things that maybe are helpful, but really some things that disadvantage landlords when they have tenants that are troubled. And so as we thought about it, we thought, boy, we ought to try to get a little webinar together to talk to our landlord friends, the lenders that lend to them, and some of the attorneys that advise them, just to try to share some of this business from the CAA. And since we had the group all together, there were some good tax changes too that maybe offset some of the insolvency related issues. So we thought we'd put all of this together, and so I appreciate the panelists that have joined us today, appreciate the attendees. And as we get ready to kick off, I'm gonna have a quick polling question that I'd like you to answer. And that question is, for today's presentation, who are you more likely to get a straight answer out of? The attorneys, accountants, or it depends? We'll give it a second. Sam can give us the answer to that. I want to introduce a couple of our law firm friends for just a second. Robert Nolan is here from Warner Norcross. He is here representing the real estate attorney constituency among the world. Bob, thanks for coming out.
Glad to be asked, and thank you for the opportunity. And yeah, my practice is I'm with Warner Norcross and Judd, and we have a full service firm. I am in our real estate group, and I do a lot of landlord tenant work, and certainly know the tenant side, but represent primarily landlords. And all that has been the last going on a year. Yeah, we've seen a lot and have had to work closely with our own bankruptcy colleagues, and welcome the opportunity here to meet another one in Joe.
Fantastic. It's a great segue to introducing Joe Grecken from Schaefer & Weiner. Schaefer & Weiner is a boutique firm that primarily works in the insolvency world, although they do have a surprisingly number of interesting non-insolvent clients too. So Joe, with that, you can take a second to give your commercial.
Yeah, thanks very much, Chip. I really appreciate the opportunity to participate in the seminar. You're right. We are a boutique insolvency firm. We do mostly bankruptcies, receiverships, and the state court litigation related to insolvency issues, but we are more of a full service business firm than people give us credit for. Among other things, we do a lot of commercial litigation and a lot of transactional work as well. And I will return the compliment to Rob. I'm always glad to meet somebody who knows so much about real estate, and it was obvious from our practice session not so long ago that he is somebody who clearly does. So I certainly appreciate meeting him. It was very nice. And Chip, again, thank you for the opportunity.
You bet. The results to our polling question are in, and overwhelmingly the answer is it depends. So no surprise there. All right, we can begin the session here talking about the impact on bankruptcy rules for tenants and the impact on landlords. And we're going to begin by just talking about a normal scenario. You've got your landlord, you got a restaurant tenant, maybe they pay you $20,000 a month on a lease. Tenant's got to pay the property taxes for you as well. They pay the utilities. It's been rough this year. Restaurants haven't been doing very well. They're about 9 months behind in rent. They didn't pay the 2020 property taxes. You're starting to get some notices about that, believe it or not. And so that's the scenario I think a lot of landlords find themselves in, whether it's restaurants or someone like that. And we're going to take a look for just a second at a couple of timelines. We're going to look at how things happened when you have a tenant that files bankruptcy, how they had time to perform under the lease to begin with. And Joe, you want to walk us through just for a second the way things used to be in blue, and then talk about the gray, which is the current rules.
Yeah, sure, Chip. I mean, essentially what this is the time a tenant has under a non-residential real property lease to perform under the lease. So start paying rent, meeting all their other regular obligations under the lease. Traditionally, under a bankruptcy code, you had 60 days. So a tenant would have 60 days to get its stuff together. They wouldn't have to perform for those first 2 months of the bankruptcy. Under the CAA, Congress has essentially given certain debtors, those under what is called subchapter 5 of chapter 11, an extra 60 days to do that. So the tenant can essentially spend 4 months trying to get things together in order to perform under a non-commercial, a non-residential real property lease. For those who are less ensconced in the bankruptcy world than we are, I should explain. Most of the people on this Zoom seminar has probably heard of Chapter 11. That's a reorganization that's primarily for businesses. Congress created Subchapter 5, which is a special subchapter of Chapter 11 last year. And it allows smaller businesses, and that's as defined by the amount of debt that the business has, to have special rules. And right now that debt limit is $7.5 million. So if you have a tenant that has less than $7.5 million worth of debts, you will almost surely be under subchapter 5, and this extra 60-day period will apply.
So Joe, as I look at this, one of the things I try to think about is boiling down what the impact is if I'm a landlord. So if I'm a landlord and I already have had somebody who's way behind in rent, the old rules, if they filed a bankruptcy, 60 days from then, I'm probably going to have a pretty good idea what's going to happen next, right? They've either start performing, and I'm going to know they intend to perform, or they're not, and that's going to be a pretty good clue too. And now for the subchapter 5 debtors, at least, they have another 60 days. So it could be, that whole 120 days before I, as a landlord, really have a clue what their intentions are.
Yeah, and you'll see in the next slide, Chip, which you're well aware of, but everybody else will see that there's another deadline too that's sort of the final indication of what the debtor is going to do, and that's even a longer timeline. But you're right. The timeline we were talking about in the last slide is really your first indication of whether the tenant's going to try to perform. It can also be an indication that the debtor thinks it's worthwhile spending another 150 days in the space, and they may get out. But at the very least, there's a 4-month period now in subchapter 5 where the debtor can sit there and not do anything. And if you're already behind on rent, as a practical matter, sitting there those 4 months can be really hard. And I think that's really the takeaway from that first slide.
Let's take a look at the second slide, if we can. This is the time to accept or reject the lease, right? So this is the longer term. This is kind of the final answer. The first one was kind of here's a hint, but this is the final answer, right?
That is correct, yeah. So in a bankruptcy, a tenant has the right to either accept or reject a lease, which means that they can assume the provisions of the lease. Oftentimes it's called assumption or rejection. And that means I'm going to perform under the lease. I'm going to pay the amounts that are due as the lease is written. Or the debtor can reject the lease, at which point the landlord is left with everything that was due pre-petition, and they don't get anything else. And that is sort of the final deadline by which you know whether the tenant is going to stay in your property or not. And the bankruptcy code has been amended under the CAA to extend that time period within which the debtor has the right to accept or reject by what is essentially another 90 days. It used to be that you had 120 days, and the court could extend it for 90 more without the landlord's permission. If the tenant could convince the court to do that for cause, which is a pretty sort of loosey-goosey standard. Now, both of those deadlines have been increased by 90 days, extended by 90 days. So the tenant has 210 days within which to accept or reject, and that time period can be extended by an additional 90 days if the court finds cause to do so. I would comment really briefly that if somebody files for a bankruptcy today and we are still suffering from significant COVID effects 210 days from now, I would expect that most courts would find cause. I can't imagine if restaurants, for example, and we're talking about a restaurant in our example here, it's hard for me to believe that if a restaurant is still at 50% capacity 210 days from a bankruptcy filing and comes to the court and asks to extend for 90 days, that the court won't allow them to do that. That is the nature of the legal landscape we're facing today.
So Joe, we're going to switch over in just a second to thinking about how we can address tenants that are getting ready to file bankruptcy or are threatening to. But before we do, sorry, we popped forward one too quick. Before we do, the thing on my mind is I'm a landlord. I'm wondering what all this means as far as when I'm going to get paid. How does it work if a tenant accepts my lease? When do I get paid? What do I get paid? Can they spread it out over a bunch of time? What happens to the past due stuff? What happens to the stuff in bankruptcy? I know there's a lot of questions there, but boil it down to, when are they going to show me the money?
So go back to the first slide. Well, the second slide, I guess, but the first slide that I was talking about. So look, after day 60 and now after day 120, they have to start paying you. The previous due stuff is going to be an admin expense. You're going to be able to pay it over time, but they're going to have to start paying you on day 120 at the very latest. Now switch over to the next slide. Whether you're going to get paid in the future is going to be dependent on whether they accept or reject. If they accept, they're just going to start, they'll already be paying at this point, right? The pre-petition stuff will get paid after the plan's confirmed, depending on what the plan says. Most of the time, you're a landlord, you'll be negotiating that with the tenant, quite frankly. But the post-petition stuff, after day 120, you're already being paid, right? Pursuant to the first slide, they can't wait anymore. The interesting thing about these two amendments working together is that they have to perform under the lease prior to the time that they have to accept your contract by a good 180 days. I mean, it's literally a 6-month period where a tenant can perform but doesn't have to accept your contract. And so you don't know whether, for example, you're going to get your pre-petition stuff or not. At least not immediately anyway.
Joe, if I can jump in, in my world, when I'm talking with the landlords, firstly, I'm already calling this the good money after bad time is where we are. We're in that arena. And your first entry on that timeline petition is filed. That's when I always feel like it's really bad. Now, we're going to wait and hear from guys like Joe, either representing us or the tenant, what is going to come of our rent that is way past due. And Chip, back to your scenario when we're 9 months in arrears and they haven't been paying taxes, I'm sure under our lease, we're going to already have had a default. So then, Joe, back to you, when we're talking about, you just said something to the effect of we're still not going to know for ballpark at 120 days on the accept or reject. So to my head, I always call that rejection leverage. They have rejection leverage on us. We're just hanging there waiting to see what's going to happen. So if we're heading into that first magic of the petition being filed and then the bankruptcy stay, I want to try to take some action prior to that before they have filed. So Chip, back to they haven't paid taxes. It's a triple net lease, let's presume. we have a default under the lease when that first tax bill hasn't been paid, let alone non-payment of rent, there's another default. So we're talking with our landlords that, hey, we want to try to switch the leverage as best we can. And then Joe, you can tell me if we're just dreaming here, but we want to switch the leverage as best we can and try to get this lease into default and then termination. So we're going to drill down on our lease, drill down on the termination provision, follow the steps because it's usually going to have timelines that we have to follow, and try to put the tenant in default and termination because, and then Joe confirmed for me, once they've filed, if it's already been terminated, that rejection leverage is gone, right?
Yeah, pretty much. I mean, if they already terminated before filing, the theory is, and again, I mean, Rob, you tell me, but my understanding has always been, from a bankruptcy lawyer's perspective, it's been this, that, you terminate the lease, there's no more lease. You don't have a contract.
They're very likely still in your premises. You don't have to kick them out, but we want to have that legal event of, we can hold up our exhibit. Here was our termination notice. We terminated them. That lease that you're trying to leverage us for another 120 days on, we may assume, we may reject, is already terminated.
Right. So you no longer have a contract or a lease to assume or reject, whether or not they're occupying the premises or not, and whether or not they are entitled to do so, because you haven't legally kicked them out yet.
Right.
Is another issue. But they don't have a lease to enforce. They can't accept a lease that doesn't exist anymore. You've terminated it. So yeah, you're right. I mean, if you terminate prior to a bankruptcy, there's a very good argument to say there's nothing to accept or reject anymore.
Right. And so the premise is, we're gonna have a hard time getting somebody back in this space anyhow. It's a restaurant. Who's going into restaurants? That kind of thought.
Right.
So they may still very well be in there. And as our landlords probably know, when you're actually doing an eviction proceeding, you get possession and judgment, but they're not out yet until the actual, what's called writ of restitution, the eviction order. So just to try to change the field of leverage a bit, it is I think a sound theory to let's move ahead on our timeline, even if they're still going to be in there and we're still going to be trying to work with them. Let's get that legal event to have occurred, the termination.
Well, and I'll add something just as a cautionary note there, which is after a bankruptcy is filed, remember, whether you have a termination or not, and whether you are, wherever you are on the eviction sort of process, remember, once that bankruptcy is filed, you can't do anything without a bankruptcy court permission. You have to get a lawyer to come in and do what's called lift the automatic stay in order to take any actions at all. That doesn't mean that you're not going to have the right to do that. I mean, if you're terminated and you're sitting with a judgment of eviction, forgive me, Rob, if I'm getting that terminology wrong, but if you're sitting there with a judgment of eviction and you've terminated your lease, you're probably going to get what you want in the bankruptcy court. You certainly should, but you are going to have to go through the proper procedure to do that. And if you don't, you're going to get punished for it. So if there's a bankruptcy, landlords should remember, hold up for a second and I mean, just go through the proper procedure and you'll probably get what you want if you prepared like that.
Right. And there's like why I call it's unhappy client territory, good money after bad. You come up with whatever names you want, but usually trundling into the bankruptcy court on your own is not going to be a good practice. So you're paying painfully sometimes to get to that process. So we try to move it ahead on the timeline to let's reduce some of that leverage they have on us.
Sam, for this next slide, please. We've kind of been in this slide space quite a bit. So what I've heard everyone is that if you've got a troubled tenant and that tenant may be thinking about filing a bankruptcy, if they file the bankruptcy before you have terminated, they have the bulk of the leverage. If you've been able to terminate ahead of time, now you've flipped that leverage a little bit. Is it the same steps if the goal is payment versus repossessing the space? Do we have any difference in strategy there? As you mentioned, not a lot of new restaurants coming around. If we're trying to find a way to make sure that tenant stays, in the least risky way possible for us. Does that change anything, or is it all the same playbook?
I'll let Joe correct me again, because I'm thinking I'd rather get the money by whatever means I can prior to, and then you may get into a look back period, and if there was any preference, but if I can leverage it up against them legally and per the lease, that we're not going to sit around and wait for you. God bless you. We empathize. However, I'm not the bank, and in fact, I owe the bank, right? So I'm going to try to get put as much leverage and pressure as possible to get paid prior to they're doing any filing, and then wait and see if Joe's going to call me up and say you're going to have to give that money back.
Yeah, I basically agree with that. I'll say a couple of things. I will start off by saying that generally speaking, getting the money is better. In bankruptcy, having the money to start off with is a lot better than trying to get it. And that's even though you might be facing a preference lawsuit, which Rob was referring to, when he talked about look back periods. Yeah, I mean, it's possible that a debtor is going to come back to you if you've gotten a bunch of money in the 90 days prior to bankruptcy and try to get back. But it's better to start off with it. Most preference lawsuits are settled. So it's better to have the money and maybe give a little bit of it back than not be able to get it. I'd much rather sit on the money any day of the week. I'll say something else, which is that the CAA, which is the act we've been talking about here, does ease up a little bit on the ability of tenants to go after landlords for preferences. That is one bone that they threw to landlords. And there's some language in there where if look, if you're negotiating with your tenant, you sort of have two reasonable choices here. One is get all the money you can and worry about it later. And the other one is, have a lawyer look at the act, figure out exactly how much you can get to avoid the preferences and take that. It's really hard to figure out how that's all going to play out in a bankruptcy. It really depends on the circumstances, but either of those choices are reasonable. I think they're, depending on the facts and circumstances, talk to your lawyer, and hopefully your lawyer's good and they'll tell you what to do.
All right, let's step down to the last slide in this section if we can. And now let's just for a second, green light think a little bit. If we're going forward under these new rules, what can we do in drafting documents to provide the most protection? I hear things like, try to get termination faster. Do we create some more draconian termination timelines? What are you looking at right now as you're writing new things?
I think that's a good thought, Chip. The tenant's coming to you with the need. You're probably already owed rent. You can look at how are you going to structure that rent. Couple terms people are, I'm sure, familiar with. You'd have rent deferral, which is, okay, you owe me all this. We're going to push that out. And you will pay me when times get better. You still owe it, but it is merely deferred. Abatement means it's gone. You're just accepting the fact that you're not going to get that money back. You can look at some structuring of what to do with this, maybe turn that amount that is owed into a loan by the landlord to the tenant, maybe try to secure that loan, changing you from unsecured to a secured creditor if the bankruptcy happens. So those are some of the things you can think about. But to your point, we want to drill down, broad strokes, we want to drill down on our default provision, our termination provision. Also, if you don't have it in there, I think you need to give a look at the force majeure provision. People are, maybe you've heard that, well, for goodness sakes, the state shut me down. I would be performing and I would be paying, but for action by the state. And we have this kind of loosey-goosey provision that we talked about. If events of God prevent us from performing. Therefore, we are relieved of our obligation to pay or to perform. You can't have those loosey-goosey. If you're a tenant, for that matter, you can't have it loosey-goosey either. So you're going to want to revisit that provision and make sure that that isn't turned into a sword against you. And because the bankruptcy courts and state courts they'll take a good look at those and see what they can do. Might be a little judicial activism there, but they will look at those and see what they can do for a party. So if the tenant needs you to restructure, you need to take a look at, with that timeline looming out there, how we can best position ourselves. And I keep going back to that. I don't want them having the rejection leverage on us, just as for planning purposes.
So, I mean, I think those are all really good suggestions. You know, apropos of the real estate expert, I think those are terrific suggestions. I do a couple more. First of all, on the force majeure, I might even require a tenant to waive any such defense. There's no reason not to if you have the leverage to do it. And if you're anticipating it, which I agree with Rob, I think, look, every lawsuit I know about right now that involves a tenant is got a force majeure issue in it. It's one of the more obvious force majeure issues that has occurred during my lifetime. And so, you know, if you can get them to waive it, I do that right away. The other thing that I don't think is crazy is looking to take a security interest in something. A lot of these tenants won't have much to get a security interest in, and that's okay. But being a secured creditor does tend to put you in a better position than being an unsecured creditor, both inside and outside of bankruptcy. And again, if you have the leverage to do it, I don't understand why you shouldn't take that opportunity.
I think that's good stuff from both of you. Appreciate it. One last quick thought, I suppose, as we're thinking about things to do to make sure we get paid. And I suppose an obvious one that maybe it's not as obvious is how we can prop up our tenant. And so one last thought, I suppose, is, you know, if we do have troubled tenants, you know, take a minute as you're talking to them to make sure that they've thought about the various stimulus opportunities. A lot of folks, of course, knew about the first round of PPP, the second round, the employee retention credit, shuttered venue grants. There's so much money floating around out there that it's likely if you've got a troubled client, they're having a hard time keeping track of it all. So one last thought, I suppose, to try to avoid all the troubles we've been talking about is if you can help your client or your tenant track down some of this extra stimulus money, it may flow directly back up to you.
Yep, good point. Sorry to talk over you, Joe.
No, you go first.
Another thing, and similar to that, is right. I almost make it sound like it's adversarial. I just am used to where, like, wait a minute, what about us on the landlord side, you know? But take a look at your lease provisions and see, do you have too stringent of use provisions? Like, you can't use that parking lot because you're in a strip mall and you share this space with others. Well, now, if we can put the tents out there for you and you can serve out in the parking lot, we're going to do that. So you look at your use restrictions, your other limitations, and do what you can for the tenants across the board.
Yeah, and I agree with that 100%. I think also, you know, there are other things that you can do for a tenant that often, look, I mean, you may be more sophisticated than your tenants. And sometimes your business suggestions can really help. I'll give an obvious example. You know, a lot of these tenants do not have particularly sophisticated accountants. And if they do not, they should be, for example, calling Raymond. Because quite frankly, Raymond's going to be able to point to tax advantages here under the CAA that they're going to be talking about soon. And some of these might well benefit these tenants and might well benefit them a lot and be able to get them some cash. You know, if the tenants, you know, are not aware of those opportunities, helping them helps you. And I think that is something that you can do as a landlord without hurting yourself one iota.
That's a great segue, I think, Joe, into the next part of our presentation, which is, boy, 2:30 on the dot. Well done. Mr. Adam Williams is going to take us through the distress leases, pitfalls, and traps from the tax perspective. We've heard a lot from the bankruptcy and the cash side of things. Here's some opportunity and some thought leadership around the tax piece. So, Mr. Williams, take it away.
Thanks, Chip. So a lot of what we're talking about today is about when the recognition of income or expense gets recognized for tax purposes, and that is going to create some weird issues that dovetail off of what Chip and Bob have been talking about with distressed tenants. So if you're a cash basis taxpayer, life is pretty good and pretty easy for you still. As you get rent, you recognize income. If you don't get the cash in the door, you don't have to pay any tax. However, accrual basis taxpayers have to recognize their taxation on rent income at the earlier of payment is earned through performance, payment is due, or payment is actually received. So payment is earned through performance is the person occupied the space during the period of time, which means accrual basis taxpayers must recognize rental income as the tenant occupies the space, whether or not they're paying you money. For the next slide. So we have distressed tenants and they're not making their payments, and Chip and Bob are talking about that. Well, accrual basis taxpayer must accrue their rent unless there is no reasonable expectation of payment of the rent. That's a pretty high hurdle. To say that you don't have reasonable expectation, you need that bankruptcy filing that Bob was talking about. Merely missing, deferring, postponing rent does not get you there. So when Chip was discussing whether you want to get the cash or you want to help the tenant survive because you're not going to get another restaurant anyway, you may have to keep recognizing income during that period of time as you help rehabilitate that tenant, even though they're not paying you any rent. So that's an issue where you have tax consequences. Now, that means that you're building up accounts receivable on your accrual basis, and if they don't pay you a year, 2 years from now, you get an offsetting deduction, but you've given the IRS a tax-free loan by recognizing all that income up front. So this is a big issue for some clients. If you've got a strip mall that's got 5 or 6 tenants, most of them in the restaurant industry, you may be paying taxes if nothing's happening, but having no cash come in the door. You might get a deduction next year, but that's not a great cash flow answer, because if you borrowed money to buy that building or rent it out, your lender will not be as generous maybe as you are being to your tenants in what you're doing. Now there's an exception to the general rules we talked about. The next slide. And that's what we call section 467 lease. Now, normally I don't like to use code sections in conversations like this with people who aren't tax nerds like me, but the actual name of this is a 467 lease. That's what the statute calls it. Now, to be a 467 lease, you have to have what they call a true lease. Now, true lease is tax speak for this is an operating type of lease, which means it's not what we call a capital lease or something where the tenant has the right to acquire the building for a low amount of money in the back end, or really just a financing arrangement. It has to be a true operating lease. And the rent agreements have to either be increasing, decreasing, deferred, or prepaid. Those are the 2 qualifications to make what we call a 467 lease. Now, most of you are looking at the slide saying, oh, I have 467 leases. All of my leases are 467 leases. So we go to the next slide and we see the exception to the exception. And that is these items are not 467 leases. Rental agreements that have total rent of $250,000 or less. Rent agreements that solely provide for rent holiday at the beginning of the lease for 3 months or less. And then rental agreements that have adjusting rents solely based on reasonable price index reflect inflation, deflation, or lease terms such as CPI. So if you have a stepped lease agreement, that's because you're expecting inflation, there's an inflation index, that is not a 467 lease. So you don't have to worry about that. So when do we decide whether something is a 467 lease? Well, upon commencement of the lease or upon a substantial modification of lease. Now that is something that may be happening a lot right now. people may be modifying leases, and that could be putting them into 467. So you might have a normal flat lease going on right now where the rent's supposed to be paid every month, but you say, hey, let's redo the lease. We'll throw that in the trash, do a new lease. You don't pay me for 6 months on this new lease, and then we'll have a different payment schedule going forward. Well, you've been retested because you substantially modified that lease by scrapping it, throwing away, doing a new lease, new length of time, some other thing. Well, now you're retested. Now you do have a 467 lease. Now note, a temporary forbearance of lease payments without adjusting the total rent due is not a substantial modification, which means that if you have a tenant that's not paying you right now, saying, that's okay, pay me back next year, double your rent in 2022, you don't have to pay me right now, but we're going to have the same amount of cash in the lease, that is not considered a substantial modification. So if you keep the same cash in the lease and you have the same leasing terms in terms of time and other contractual provisions, you have not substantially modified the lease. You do not have to worry about falling into this 467 trap. Okay, so we've talked about section 467. What does that mean? What are the consequences of falling into a 467 lease, the exception to the general rule of when you recognize income? Well, if the lease is a lease that has certain characteristics, which is a sale leaseback or a long-term lease, you'd have to use what we call the constant rent accrual method. And this is a great complicated mathematical model to basically flatten the lease over time, even if you have increasing or decreasing lease amounts. What you do is you set the rental amount equal to NPV of amounts payable divided by the present value of $1 to receive the end of each rental period. That's a great exercise for people that work at firms like me to build nice spreadsheet models, but most people don't want to do this. It sounds really miserable. The second one is even more miserable. So this is if you don't have a long-term lease or sale leaseback, and that's the proportional rental accrual method. There you treat the lease as partially a financial arrangement. So you bifurcate lease payments between rental income and interest income. And a tenant would have interest expense and rent expense. That can have some consequences under our new interest limitation rules. In addition, that the interest income would be considered portfolio income, and that have consequences under the passive activity loss rules. So this is going to have unintended consequences that people don't consider as they're going through this lease. So how do we get out of the 467 trap? Well, you get out of it by providing what we call a rent allocation schedule, where the lessor and lessee agree to recognize rent income expense in a specific allocation. The reason this statute was put in place in 1984 was to stop the situation where a cash basis taxpayer on one side could front load all the rent expense and get a huge deduction. And my accrual basis taxpayer on the other side can spread it over the life of the lease. It was a great tax planning idea. This is intended to stop those sort of games. Now, if tenant and landlord agree to a rent allocation schedule and place this inside the new substantially modified or new lease arrangement and say, okay, we're going to agree to match everything up on this rent allocation schedule. You take the deductions according to the schedule here, and we'll take the income in according to the rent allocation schedule. You have to go through some hoops, have some specific language in there. This is a rent allocation schedule to be considered for section 467 that gets you out of those two financing arrangement rules we discussed above, the constant rental accrual method and the proportional rental accrual method. So we have a general rule, we have an exception to general rule, we have an exception to the exception to general rule, and then we have a way to work our way around the exception to the general rule. All this adds a lot of complexity as you're considering redoing lease arrangements in this downturn. So if you're entering into a new lease or substantially modifying lease, I strongly recommend you reach out to somebody at Raymond or somebody like Bob Nolan or Joe Grecken and discuss these things before you enter into that new agreement, so you don't end up in a situation, which was on slide 2 of my discussion, where you're writing checks to the IRS and getting no cash.
Thanks, Adam. Definitely fall into the category of it depends. I think on a lot of things.
Well, you know, when you said, who do you trust more, the attorneys or the CPAs? I kind of had to sit and laugh because I'm both. So I have a law license and I took the CPA exam. So I'm one of those real hardcore tax nerds that have gone both directions.
We didn't have her choose A or B. We should have had that option.
Yeah, option D, or a recovered attorney. Fantastic. All right, we're going to sneak over, I think, next to HP to walk us through what I think I understand is a reduction in the cost of taking accelerated depreciation. Some opportunities where we can meet our goals a little more efficiently and less costly. So I have just about exhausted my knowledge on the subject, which is a good time to hand it over.
Hi, everyone. During most of it, what we'll cover during next few slides is the impact of the new law that will benefit businesses in residential rental industry. Let me give you a quick background on changes to Section 163J under 2017 TCJA Act. So let's go back to 2017. Section 163J limits business interest expense deductions based on a calculation. Generally, this section applies to every taxpayer. The changes to 163J were effective taxable year starting after December 31, 2017. There were exceptions to Section 163J limitations, and there were multiple of them. But one of the exceptions was if taxpayer has interest expense from one of the accepted trade or businesses. We'll go over what the accepted trade or business is. There are several of them, but one of the accepted trade or business we'll focus is an electing real property trade or business that we will discuss in the next slide. Thank you. Under TCJA, in general, some of the businesses that could make this electing real property traders business election are real property trader business that includes real property development, redevelopment, construction, reconstruction, acquisition, to name a few. Eligible taxpayers were allowed to make one-time irrevocable this election. I will call this election during the presentation as a Rptb election for simplicity purposes, with a timely file return, including extensions, to opt out of business interest deduction limitations. So essentially what that means is if eligible taxpayers would make this election to be electing real property trader business, they don't have to apply business interest limitations under Section 163J that was placed in under 2017 tax law changes. CARES Act, which was passed earlier in 2020, allowed retroactive provision to make late Rptb election and to withdraw from a previously made election. Essentially, before it was a one-time election, and when you make it, it's irrevocable. But when CARES Act came into play early in 2020, it allowed us to make late election, allowed taxpayers to make a late election, or they can even withdraw from previously made elections. Below is just a quick table that shows the impact of the election under initial TCJA Act. Once you make this election, use of ADS system, which is a type of depreciation system, that was required. So for non-residential real property, generally you depreciate the property for 39 years, but once you make this election, you were required to depreciate over a 40-year period, which is a big area where it's just a 1-year differential. And by making this election, if you are able to get out of any business interest limitations, it's a great idea. Initially, the residential rental property in service post 2017, the general depreciation life was 27.5. However, ADS life was 30. However, the big change that happened under the new law versus TCJA was the residential rental property, which was placed in service pre-1118. What that means is, so if you acquired or placed the service property before that date, generally you depreciate that property over 27.5 period. But if you made this election and you're required to use ADS, you were required to depreciate over a 40-year period. Next slide, please. The new act allow eligible taxpayers to use the 30-year recovery period retroactively for all residential rental property. Let's quickly discuss what that means. So the last column, which is, we are focusing on here, is residential rental property placed in service pre-1118 time period. So before, under ADS life, that was 40 years. However, now it's only 30 years. So the cost of making this election is much more favorable than before. So that's one thing I would say, keep in mind, if you have not made the election before, or so now is the time to rethink. Under TCJA, switch from 27.5-year life to a 40-year life for pre-January 1, 2018 assets was often onerous to real estate owners, and that precluded them from making the Rptb election due to a reduction of annual depreciation expense. So it was a play between, do you take less depreciation, or you get out of your business interest limitations. So the cost of doing that was much higher. However, now, since the cost is much lower, since you're only thinking about a depreciation life from 27.5 years to 30 years, I think this is a win-win scenario now. I think you should be able to get more out of making this election and kind of getting out of 163J business interest limitations. So it's worth reconsidering the Rptb election under new rules, since it allows the taxpayer for faster depreciation using a lower 30-year life for residential real property placed in service before 1118, while at the same time opt out of business interest limitations. What's next? I think taxpayers should analyze how the Rptb election may provide you with tax benefits. The election may provide significant benefits to applicable taxpayers with significant business interest limitations on specifically on residential real property. So if you have not made this election and you have significant business interest limitations in play, I think this thing is in play. We can certainly assist with the analysis if this election is worth being made, or we can compare different scenarios for you. For some taxpayers with residential rental real property, 163J related business interest limitations can be very steep, which kind of stops you from taking that business interest limitations in this year. So making this election and opt out of business interest limitations may provide substantial tax benefit. For taxpayers, even for taxpayers with commercial rental real property business, this election comes into play as well if they haven't assessed the benefit of making this election yet. So I know the new change under the new act is specifically geared towards residential real estate owners. However, if commercial rental property owners, if they haven't looked into this area before, I think it's worth looking into. If you have already made this election in prior years, I would say wait for forthcoming IRS guidance before you make any changes. Although specific guidance is pending from IRS, it is presumed that the IRS Form 3115, which is a form that's used for accounting change method, could be used to make this change in the depreciable life. We're suspecting there will be a forthcoming IRS guidance on this, which possibly will show us some alternate procedures how to do this task. So that's the reason I think we should wait for it and see what IRS has to say about this. Refer to the guidance under this RPROC. Generally, I just wanted to mention this out there, that if you have not made this election before and would like to make this election retroactively, under this guidance, there is a way taxpayers could do that, which mostly requires amending of prior returns to make that late election. And as I mentioned, if you would like us to do some analysis to make sure if this election is worth making, definitely please reach out to us and we'll be happy to assist you with that.
My guess is the first thing we can help with is helping people figure out if they've made the election or not, because I'll bet most of us have no idea.
Yes,
If
that
we have or
I
haven't.
totally agree.
That and trying to figure out if you're even subject to 163J, which can be a massive exercise in and of itself.
I agree, and this change in before, as I said, for residential property owners, I think they were kind of stuck between, do we take a less depreciation by making this election, and do we take a higher interest deduction, or so there was a play in between. However, now I think it's much more favorable. You're allowed to take higher depreciation now under reduced 30-year life, and at the same time you are able to get out of 163J limitations, which is a win-win, I would say.
Fantastic. All right. We are amazingly right on schedule, which brings us to the closer, the heavy hitter coming in here at in the ninth inning to wrap us up. Mr. Andy Rose, tell us about tax provisions.
Well, I'll try to keep us on schedule here. I don't want to be the one that takes us off. So of course, one of the big questions is we're spending all kinds of money sending out checks and, spending trillions of dollars on stimulus and, relief packages. So what happens? How do we pay the bill on that when it all comes due? So of course, Biden was not shy about disclosing his intentions to raise taxes when he was platforming for the president. And so at this point right now, I'm going to kind of walk us through what we know, and this is changing quite frequently as cabinet positions are filled out, and we're starting to get more and more of a look inside of what this could possibly look like. So it's interesting. I just read today that the new Treasury Department Deputy Assistant Secretary for the Treasury, which is Mark Mazur, has not ruled out retroactive tax changes. So, which is very concerning because we were hoping that, they'd be focused on other things, including rolling out the vaccine and just getting the economy to a stabilization point. So he did indicate that it's not the preferred route, however. So, focus again is currently on COVID-19, and we'll see what they do in the interim. But that's a little troubling. I will add a little bit more to that he said, there's some specific items, and he did not enumerate on what those items would be, that have been talked about for a while now. And so really kind of saying, hey, taxpayers have been on notice. So if there's a few things that we do that are retroactive, hey, we kind of gave you some heads up. So I'm not sure exactly what that is, but, there was a lot of state gift and trust tax changes, or I'll just say, state gift and trust transactions going on at the end of 2020. So that could be one of the things that they're talking about. I don't know. We'll have to wait and see. The big target in a Biden presidency is those making $400,000 and above. There's numerous changes that are targeted at that income level, including raising the overall tax rate, the highest marginal tax rate, from 37 to 39.6, which would bring it back to where it was pre-Tax Cuts and Jobs Act, which was passed at the end of 2017. We would have a donut hole on Social Security payroll tax. So you'd reach somewhere, it's got to be around 140,000 probably now, where you top out on your Social Security, both employer and employee. So you'd stop at that annually adjusted level, and then you'd kick in again at 400,000, and there's no cap on that. So both employee and employer would start the clock again on Social Security at 400,000 and above.
Hey, Andy.
Yeah.
When you say the $400,000 target, is that gross income, AGI, taxable income, some other number?
I believe they're looking at just the gross income here. I'm not sure that we've seen that kind of detail. Again, we still have a lot of high level, 30,000 foot view. So whether it remains to be seen, is it some kind of modified AGI? Is it AGI? Is it taxable income? But somewhere, one of those things will be pulled into the calculation. we're going to see a reduction in the benefit of itemized deductions possibly again too. So we used to have what's called the PEAS limitations, which limited the use of interest and state and local taxes and donations and all those types of things. Well, that went away with the TCJA back in 17 as well. It's a possibility that we could see some kind of resurface of that again. So just be aware of that. Here's another big thing that's being talked about. For those earning more than $1 million, and again, I don't know if that's AGI or taxable income, but you'd be taxed on your capital gain at ordinary income rates. So that, that's basically almost doubling your capital gain tax rate if that occurs. One thing to point out too, and I want to focus on this area because there is a lot of talk about the capital gain rates and just capital gain transactions in general. And I think this has a very good chance of being one of the revenue raisers. So I think it's important. We know we've got real estate clients and on the call with us. So 1031 is still around unless that's for some reason would be eliminated. But man, everything I read on that says that that's just probably not going to happen. So consider that. Consider opportunity zones, and consider again section 121, which is your personal residence exclusions. What I'm getting at, section 453 installments too, is start to look at some of these ways to, if all of a sudden capital gains are taxed at ordinary rates, start looking more into some of these ways that we could possibly defer it. It seems like every 4 years there's some new agenda that comes in. So if we could possibly defer it, most likely we wouldn't be deferring into a higher tax rate, and possibly all of a sudden we're back to a 20% capital gain rate. So that would be something that I would be considering if I've got large capital gains coming my way, and we all of a sudden start to see that Biden is being successful in getting some of these raises. Again, the state tax changes, those have been talked about for a while now. He'd like to reduce the lifetime exemption. I've seen anywhere going down to 1.5 million, 3 million, 5 million, but certainly quite a bit different than the current almost 12 million. Eliminating step up at death, which is a huge change, and it's going to create a lot of problems too. There's new credits on the table. First time home buyer credit, it would be a $14,000 credit, and I believe I saw that would be payable directly to the title company. Now how that's going to work, I don't know. Again, we don't have those kind of details. On the business side, we're currently at 21% if you're a C corp. It's been talked about going to 28. More likely than not, it probably falls somewhere in the middle. I've seen 25. There'll be some compromise probably on this provision. And 199A, which is a 20% deduction on pass-through income. So if you have a partnership or an S corp and you're kicking out income on a K1 to partners and shareholders, a lot of times that is what's called qualified business income, and you can take a 20% deduction against that. That would be limited and would be eliminated at 400,000 and above. Significant dollars there as well. We're going to see some kind of revised alternative minimum tax for C corps. It was gone and could possibly rear its ugly head again, but it would be on pretty sizable firms, 100 million or more in net income. GILTI, which is meant to decentivize those from moving profits overseas, that would go from 10.5% to 21%. There's some things that Biden's proposed to essentially create more manufacturing here in the United States. So if you're expanding facilities, reopening facilities, reshoring, there's penalties for taking it the opposite way, and there's credits for bringing it this way. So one other thing, because everybody, this is something that's on everybody's list of questions, is what about the SALT cap? Well, I don't know. you know, you might look at something today and says it's going to be eliminated. You might look at something tomorrow and nope, they're not going to touch it. They're going to let it sunset in 2025. It is all over the board right now. So whether or not we get removal or elimination of the SALT cap, which impacts far more people than you think it might at $10,000 in taxes, and that's real estate income, state, local. So whether that dies an early death, I don't know at this point, but continue to keep our eye on it. So with that, Chip, that's all I have.
All right, Andy, just to tie a bow on that SALT cap, you know, that would decrease revenue, right, if we eliminated that cap?
Yes. Yep,
Man,
it certainly would.
That does not seem like the direction the service is going.
It doesn't, but you know, the talk is right now, if they do eliminate that it would be, you know, they like to net out to a neutral point on, you know, whenever they give something, they like to take something away. So what I saw is that, you know, that could possibly be negotiated along with that 21 to 28%. So depending on what they need to pay for it, you know, if it means it goes to 26 instead of 25, well, you might see that.
Gotcha. All right. Well, thank you much. Pretty well on time. Haven't been a lot of questions come through the chat. Maybe we've had some individual. You know, feel free to follow up. You'll all probably have gotten an email with the PowerPoints and the speakers, and of course, love to have you reach out with questions. And with that, I really appreciate each of the speakers today. Appreciate the audience, and just thank everyone very much. And I think that will be an official wrap until next time. So have a great rest of your day.
Thank you.